Hi guys, this is Terry with Futures IO. It is an honor to welcome Brannigan Barrett for today's webinar. He is doing a presentation on trading within context, the art form to trading. If you have questions, you can type them in the questions box and we'll do our best to answer them during the event. If you're watching this on YouTube, please do us a favor and give us a thumbs up if you enjoy the webinar. Also, please feel free to share, comment, subscribe to our channel. It really helps us a lot. Without further delay, I'll hand it over to Brannigan.
Thank you, Terry, and good evening to everyone listening on the outside there. And obviously, welcome to everyone that I have sort of met before and spoken with before. To all of those that don't know me, as Terry said, my name is Brannigan Barrett. A little bit about me: I'm originally South African, and effectively, I'm started my career in South Africa. I went to university there, did a degree in Econometrics. I then sort of started out as a broker, so I brokered at a treasury outsourcing firm, predominantly currencies, and after sort of brokering for 2 years, I kind of realized that I didn't really understand trading per se. I didn't really understand the dynamics of the market, and so I kind of came abroad to the financial center of the world, and I started trading at a prop firm called Futex, and I went through their graduate scheme program, and after a couple of months I went live and started trading. So a little bit about me in terms of, if I can go to that. So obviously I've been in the financial market for 7 years now. Started as a broker, moved on to a trader, and then sort of moved into the mentoring space. Now, a little bit about why I went into the mentoring space. Well, after about a year of trading, I realized how difficult it was to actually start breaking even, cover the costs, and sort of start making a salary for myself. So the opportunity presented itself that I talk to the graduates at the end of every day for an hour. And initially I kind of thought, well, good opportunity to make a little bit of money, good opportunity to sort of just pay the rent effectively. But over time it actually became a little bit more of a passion, and I'll tell you why. What I found is by mentoring, by talking about key concepts, by talking about key principles, you actually start to reinforce your own principles and beliefs and understandings. And as a result, I actually found that my trading developed very, very well, and I started actually sort of making very good inroads into my trading. So you should have a pop. Oh, okay. Sorry, there we go. Sorry about that, thanks. So that's kind of how I became a mentor, and ever since then, now I mentor people more, and I enjoy talking to people more because, one, obviously I can help people, but two, again, it reinforces my principles. So as you can see, sorry if you just come on, that's a picture of me on the left there. I didn't want to put one of those goofy little professional pictures up. So that's me in Egypt having a cool time. So moving on then, products trade. So I started originally as a German Bund trader, and I started out there, and then I moved on to trading a bit of DAX. Scared the life out of me trading the DAX, so I kind of eventually gave up on the DAX, and then moved into trading the Eurostoxx 50, the US 10-year notes, the S&P 500, Euro, sterling, and then the oil and the gold. So I've kind of, over the years, I started initially in 1 or 2 products, kind of, got a little bit more of a taste for more, sort of markets that move a little bit more aggressively, adapted my style there, and then sort of moved out. So now, obviously, trading multiple asset classes. In terms of the day my career began, it's quite a fun little story. This was 2012, and it was just after the Italian elections, and it was a cold, frosty morning in February, and I remember the Italian election result came out pretty much against what the market expected. To cut a long story short, I sold the open of the BTPs, and it actually gapped, or it white boxed and gapped, and at that point my P&L was showing something amazing, like probably 5 to 10 times the biggest ever update I'd had, and I got all excited, and I started giggling, but of course it wasn't a realized P&L. Eventually, when the market did open again, it actually opened higher than where I entered, and it was just complete mayhem, complete craziness. But to cut a long story short, I didn't make much money out of it. But that day made me realize the job we're in, which is to take calculated risks. And when those calculated risks make sense, you need to go for it, and you need to really sort of make the most of it. So that was the day my career, sort of really got going back in 2012. Then, just in terms of my career motive, guys, the reason I want to share this with you is because it's so important. This job is so difficult that you have to, when times get tough, you have to have some sort of a motive, something that sort of reinforces your beliefs as to why you're doing what you're doing. So, my career motive is very simple. I started trading because I want to travel the world and experience the abundance of culture at the expense of the markets. That's why I do it. Ultimately, I want to become the best trader I can be, but I don't want to sell my soul for the cause. In other words, I don't want to give up everything just to be a trader. And then most important, I really would just want to make a difference, in the lives of others. And if that means sort of helping in whichever way I can, then that's what drives me every day. That's why I come back and sometimes take the punishment that I do in the markets every day. But so that's why I have a career motive, and hopefully you guys can create your own career motive for yourself. In terms of my strategy, well, I am a professional prop day trader. I trade every single day, Monday to Friday. If I could, I'd probably trade Saturdays and Sundays. But unfortunately I can't, so I just spend Saturdays and Sundays prepping for the week. In terms of the kind of stuff, I do probably roughly 20 to 30 unique trading opportunities a day. That can range from, swing trades to fading to, event risk trades to scalping. It can anything that's going to give me the opportunity to make that next increment. It's an opportunity for me to make money. So that's more or less, what I do in terms of my days. In terms of time frames I trade off, well, today I'm going to predominantly focus on a weekly and daily time frame. Obviously because the retail market focuses a little bit more there in that time frame. But I also do trade on the 60-minute, the 5-minute, and even sometimes a 1-minute chart. So it's so important. I know a lot of people always ask this question: which time frame do you trade on? Well, the important thing to understand is, guys, there is opportunity on every time frame. So you just have to understand that opportunity, identify it, and then take advantage of it. In terms of my favorite trade setup, well, I have a trade called a position reversal trade. Very simple. The whole market's long. There's a natural long in the market, and it's an intraday strategy where the whole market is a little bit biased to the upside, whether that's technically or fundamentally biased. And what ultimately happens is everyone gets caught in this trap of we can only be long because of the technicals or the fundamentals, and as a result those positions tend to get washed out quite aggressively, and everyone kind of panics and tries to get out at the same time, and it's hell of a fun to watch and a lot of fun to make money off. So that's probably my favorite trade. In terms of my biggest strength and biggest weakness, well, I'd say my biggest strength is obviously my work ethic. I have a little acronym called FILO, which is I tend to be the first in the office and I tend to be the last out of the office. So that's definitely one of my sort of biggest strengths. My biggest weakness, well, if I believe in a trade, I can actually be married to that trade until the risk manager sort of divorces me. So that's kind of can be sometimes a weakness when I'm a little bit too strongly convicted in a trade. So the important question: why am I conducting a webinar? Why am I doing this? Why am I what I want to achieve today? So for me, it's very simple, guys. I'm conducting this to add value to the community, to add value to the retail market, to maybe help a few of you have a better understanding of what day trading is about, and what us professionals look at on a day-to-day basis. And hopefully I can just open some of your eyes today to some of the information that's out there for the retail market. Unfortunately, it's not very good, guys. It's so for me today, I want to dispel a lot of the truths, but I want to kind of just get you guys to start thinking for yourselves. If I can do that today, then I would have achieved something quite good. So yeah, let's move on. All right. So my goal for today, whenever I do a webinar, or obviously for the people that know me, when I do a Periscope, or for the people that have been watching Futex live, I always have a goal. So what I want to achieve today is I want to teach you a methodology to apply your recognized patterns within the provided context, rather than you enforce your patterns into context. So we're going to come back to that at the end. That's going to kind of be a summary at the end, but that's our goal in mind today. Now, my objectives, how am I going to achieve this? Well, firstly, I need to get the idea of context over to you. If I can get that over to you, I've achieved my first sort of objective. I'm going to do that theoretically practically, and then I'm going to make you apply it. So I'm going to give you a very hands-on type approach today, so that you can really sort of take away something from this this hour. Then and it's going to be geared towards beginner, intermediate, and advanced. So there's something for everyone, and it's going to be simple, guys. I'm going to keep this so simple. I'm going to keep it very effective, and I'm going to make it nice and powerful for you. And then the last thing, ultimately, I want you to be able to apply your patterns within a context type environment. That is my main objective for this webinar. Then, index, what we're going to do, we're going to start off, I'm going to introduce the concept of context. I'm going to move on to 8 principles of market context. I'm then going to get you to apply those 8 principles in practice, okay? And then I'm going to show you 3 unique candlestick patterns. We're then going to apply those 3 candlestick patterns within the context provided. And then we're going to talk a little bit about order flow. I'm going to show you a nice, cool video. I'm going to show you sort of how everything comes together from context to sort of the price pattern, and last but not least, the order flow. So we're going to bring them all together in sort of some wonderful little climax in point or in index number 6. We're going to talk briefly about risk-reward using context, and then we're going to move on to the future of trading and the power of trading context as an analysis form. And then last but not least, we're going to move to Q&A, and as Terry said, we will have a point after sort of index number 3 where we can take a little break and ask a few questions. But most of the questions, let's try and save until the end. So let's go, let's kick off, let's get going. All right, the principle of context is very simple, okay? The textbook, or not the textbook, sorry, the definition in the Oxford Dictionary is that context is the circumstances that form the setting for an event, statement, or idea, and in terms of which it can be fully understood. Now, Brannigan's definition of market context is very simple. It's the price and time, it's the price, time, and backdrop against which buyers and sellers must make decisions on judgment of fair value. Okay, let's say that again. In other words, it's the price, time, and backdrop against which a buyer and seller, they must interact with one another, and they must make a decision as to where they deem fair value to be. Okay, now we're going to start off, we're going to talk about what is market context. Okay, sorry, so that is the market. Now I'm going to show you an example of what is market context. So effectively it's this little, it's the when did we get here. In other words, if you look at this diagram or this chart, okay, at any point in time you have to say to yourself, when did we get here? In other words, what time did it take for us to get to this point from the point we've come from? Okay, where did it come from? That's the second point, all right? Where have we come from? In other words, if we look here somewhere, we've come from a very low base and we've come very quickly, okay? How did we get here, right? Did we get there in a straight line? Did we rotate sideways? Did we go, very aggressively up, then very aggressively down, then very aggressively up, okay? So how did we get there? Then why have we come here? What was the reasoning behind that market getting there? Was it technically driven? Was there something fundamental in the market? Okay, and last but not least, who brought us here? Okay, now so important, and this a lot of people scratch their head when I say this. They think, well, the price went up, therefore buyers brought us here. Okay, that's not the case, guys. Okay, a market can go up when buyers buy it, but also when sellers liquidate. Okay, so it's so important to understand, just those 5 questions. When did we get here? Where did we come from? How did we get here? Why have we come here? And who brought us here in the first place? Okay, so that is market context, and that's what we're going to try and answer by the end of this webinar. Okay, so why do we use it? Well, it's very simple, okay? We use it because, one, it's an extremely powerful tool. Okay, I'm going to talk a lot about this, but market context is a tool that's not readily available. You can't just put it against the chart and suddenly you start making money. It's not a signal indicator or anything like that. Context is an understanding of a backdrop, or an understanding of where we are situated in price and time, and you make decisions to buy and sell based on that backdrop. Okay, it's a very flexible tool. All right, what I mean by that, it's dynamic, okay? Because it's not linked to any, past data or anything, it's always forward-looking. It therefore becomes very dynamic. It adjusts as the market adjusts, okay? If the market becomes more volatile, well, context will show that we are more volatile. Therefore, we adjust, and we're adjusting straight away. Okay, it's as I said, it's very forward-looking, it's very dynamic, and it gives us, the reason we use it, most important, it gives us a manner in which we can deploy recognizable patterns. And I'm going to go through this in a bit. You'll start to understand a little bit more as I move on. Okay, so what are some of the benefits of it? Well, the most important benefit of market context is that, ultimately it's going to give us a higher probability of success, right? Now, I know a lot of you are saying yes, but, tools give us an odds. But ultimately, guys, I'm not saying get rid of the tools. I'm not saying, get rid of everything you learned. What I'm saying is keep what you've learned. Let me show you a little bit of context, and then go back to what you've learned and see if applying context is going to change the probability of success for you. If you can do that, then you understand market context. Okay, so that's the main one. Obviously, the second most important one is forward-looking, guys. Tools are all lagging. They're all based on past data, on past events, on old price information, old news, right? Contextual, backdrop is always forward-looking. It's always with the times. Okay, what are some of the weaknesses? Well, probably the biggest, the biggest weakness is that it takes time, guys. Developing market context, I cannot teach you. I mean, tonight we are just going to scratch, the surface of what market context is about. This takes, can take, depending on how much time you allocate, it can take you 6 months to a year just to grasp the basics of market context, all right? And the reason is because you are going to need to experience a lot of different market conditions, okay? And that doesn't happen overnight. That doesn't happen over a week. That happens sometimes over months and years. So that is probably the biggest drawdown, is that this concept takes some time to develop. But once you have it, guys, you are equipped with a very, very powerful tool. Okay, so how do we implement it? Well, very simple. You implement it via a model, and I'm going to show you this model, this principal model that you can take away at the end of today and start applying. So I will share that in a little bit. And then how long to become proficient? Well, as I said, guys, it depends how much time you allocate. All right, I've seen some fantastically good prop traders, day traders, that I mentored. They came in, 6 months later, they were making money, and a year later, they were making extremely good money. And so it can be done, guys. You can become proficient at this. It all just depends on how much time and effort you can allocate to it. Okay, that's the principle of context. So let's move on then. What are these principles? Well, there are 8 of them. In fact, there's probably a lot more of them, but I've tried to condense it into 8 principles I can share with you today. So very briefly, the first one is trend. All right. The second one is trade location. The third one is market positioning, volume and volatility, paper flow versus technical flow, fundamental flows, time, and then correlation analysis. Okay, those are the 8 principles. Don't worry about writing them down. I will give you a nice little snapshot that you can use a little bit later, that you can take a snap of, and you can utilize in the practical example. Okay, the first one, trend. So the first thing to understand, guys, when we start developing these principles, rule number 1 is trend. Okay, so what I'm saying is you need to be able to look at a chart, and straight away you should be able to identify the short-term trend, the medium-term trend, and the long-term trend. Now, this in its own, guys, this is probably a 3-4 hour discussion. Why? Because, well, how do you determine what a short-term trend is? Okay, for a short-term trader trading on a 1-minute chart or an algorithm, all right, he's going to use, the last 5 or 6 minutes as the short-term trend. Whereas, for me, based on the chart I'm showing you here, which is a weekly trend, well, at the moment, a short-term trend could be almost 2 months. Okay, so trend in its own is a very sort of, there's no hard, fast rule. You have to develop this concept for yourself. But the important thing is you need to learn to develop an understanding of how to determine the short-term trend, the medium-term trend, and the long-term trend. Now, the way I would do this typically is I would look at this chart, so what we've got here is a weekly euro dollar, and I would say to myself, well, at the moment, okay, the short-term trend for me is relatively sideways. Now, I tend to lean on moving averages as a confirmation tool of my trend. Note, I don't trade off moving averages. I use them as a tool to determine my trend. Now, I can straight away see that almost for the last 3 months, this moving average, this 20-week moving average, has gone completely sideways. So straight away that's saying to me, in the short term, there is no trend. We're in a very neutral sideways trend. Okay? Then, in terms of a medium-term trend, well, I would like to think, or I'd like to use, almost the last couple of, since the beginning of 2015, this entire block here, and I'd say, well, that's probably my medium-term trend. Again, I can see that we are very firmly in a sideways medium-term trend. Okay, and in terms of a long-term trend, well, as we can see, since late 2014, we had this very aggressive sell-off in the euro, and since then we've just sort of condensed into this, whatever you want to call it, 11 cents range, okay? And so for me, the long-term trend now is in, what I'd like to think of a flag type formation where the market sold off and now it's just moving sideways, accumulating and distributing over a couple of months. Okay, that's how I would determine my short-term, medium-term, and long-term trend. Now, obviously, like I said, you can use moving averages, you can use trend lines, you can use all sorts of tools to determine what the trend is. The important thing, guys, is that you need to be able to, at the end of, this first principle of trend, you need to be able to say straight away, what's my short-term, what's my medium-term, what's my long-term. If you can do that, all right, you're already, in terms of context, you're already going to be fighting on the right side of the page because, one, you're going to know, firstly, when you are trading with trend, but more importantly, you're going to know when you're trading against trend. And note, guys, it's important as a day trader. I will trade against the trend, I'll trade with the trend, I'll do all sorts of crazy things so long as I have an edge. But at the end of the day, I always understand, am I going against it or am I with it? All right, so that's our first concept or our first principle, trend. Then trade location, a very important and unique principle, and there's probably not enough people that talk about trade location. So what is trade location? Well, very simply, guys, it's the price at which we are trading right now within a range. Okay, so if we are in a long-term downtrend, all right, we expect that the trade location should be somewhere towards the lower end of that downtrend. All right, if we are in a sideways market, as you can see in this euro daily, the euro-dollar daily example, we are very firmly at this current point trading in the middle of this wide range. So you can see our range is somewhere around this 106 to 116, currently trading 113. So in terms of trade location, we're firmly stuck in the middle of a sideways range. So straight away, I've got to say to myself, well, the big picture is that sellers are selling high and buyers are buying low. Okay, but for me as a trader, I know that if I start partaking somewhere at current prices, well, I'm participating in the middle of a range. All right, so straight away, I accept the fact that in terms of trade location, I'm trading where there could be a fair amount of noise. All right, so important, guys, in terms of trade location, you have to learn to understand and you have to learn the concept of when a market is trading at discount or when it's trading at a premium to fair value. So what do I mean by that? Well, it's very simple, okay? As you can see, this market has been moving sideways for some time now. Now, anytime we are sitting at higher prices, all right, that's when the market is trading at a premium. How do we know that? Well, we can see that every time the market gets to or got to higher prices, it gets very aggressively rejected. Then, when we get to lower prices, we can see again the market tends to reject. Therefore, we can straight away say to ourselves, well, at the moment, this market is, we have a premium price somewhere around 116, and we have a discount price at 106, okay? Anything in between, we are trading more or less around fair value. Now, again, you can use certain tools to determine, one, where is fair value, one, where is premium, where is discount, right? What I would tend to say is, obviously, speed of highs and lows tends to indicate discount and premium, whereas acceptance or a lot of two-way trade around certain prices, as we can see in this area or this area, that tends to indicate fair value. So again, so important when talking about trade location, make sure you understand where is that discount area, where's that premium area, and where is fair value. Okay, other indicators you can use obviously is overbought and oversold indicators, or as I said, any kind of previous resistance and support lines. Okay, so that's our trade location principle. Then, our next principle, market positioning. So important, guys, and not enough retail traders are ever actually, let alone thinking about this. They're not even talking about this. So when you are in any kind of a position where you're about to get involved, ask yourself, what is the market's position at this point in time? Now, you get three positions. One, neutral. 2, bullish, or 3, bearish. Now, what do I mean by market positioning? Well, I've got 3 examples, and I think that'll help explain what market positioning is. Now, the first example, as we can see, is the euro-dollar daily on the left here. Now, we've got this huge, wonderfully big green candle here, and we can see the next day, we get a little bit of a consolidation day. Now, straight away, if you come in and you're not looking at any of these, candles, past what we've got, you've got to say to yourself that this market currently, after what we've seen and the price response, there is a net long bias in the market. In other words, this market is looking to move higher. It's just consolidating at present levels. Now, the important thing to understand is that once we get this sort of, this inside coil day, we're expecting this next day, once we take out that sort of swing high, we're expecting some acceleration, some speed. Why? Because the market is net long. In other words, we expect the buyers to continue to control the situation. Right? However, as we can see, the very next day, the market comes in and sells off. And it sells off pretty aggressively. And the reason is because we can see that net long position finally got washed out. Okay, so important, guys, to understand market positioning. The next example. Again, we can see here over a period of time, over a couple of days or weeks, we can see that the euro-dollar very aggressively sells off, just one time framing all the way down the page, all right? And what we know at this point is that the market at this point is net short. There's quite a lot of shorts in the market, probably a lot of people that haven't got in on the short, and obviously no one wants to be long in fear of getting washed out. Now, just knowing that, understanding that we've had this very aggressive down move, an overly aggressive net short position, would stop us from trying to get short too aggressively, because if we had got too short too aggressively like everyone else did, this was the result where we got the washout trade. So again, that's why we want to interpret market positioning, because it's going to prevent us from sometimes entering in trades that we shouldn't be getting involved in. And again, this will all start to make sense once I've gone through the principles. Okay, our last example, it's a 60-minute euro-dollar. It's a typical trend day. Again, note, you can see the one-time framing on the red candles. More importantly, we take out key support levels. We know, that this market, as a result of one-time framing and trending price action, that there's a net short in the market. Okay, so again, straight away, when we see that kind of positioning, we say to ourselves, well, we definitely don't want to be, sort of looking for any kind of longs in this market. We only really want to be leaning towards short side pattern recognition, and that's kind of where this whole thing's going to lean towards. Is first, if we understand the market positioning, if we get a pattern that we recognize that fits within our context of market positioning, we take that trade on. Okay, so those are three sort of examples of market positioning. Again, I've listed a couple of things within market positioning. Where does that long-term paper come in? We so often see long-term paper stepping into markets, and that forms the high or low of a trend. As well as we so often see daily trend days. Yet as traders, we sit there trying to fade it when there's a very strong net bullish or net bearish bias in the market. Okay, so let's move on and talk about our fourth principle, volume and volatility. Now, so important, guys. Again, a lot of traders and a lot of day traders don't talk enough about this. So what do we mean by volume and volatility? Well, it's very simple. For volume and volatility, we want initiative flows. Okay, what do I mean by initiative? In other words, when buyers or paper buyers deem that price has now reached a discount point, okay, they're going to initiate very aggressive buy-side programs. Why? Because, well, if they felt that oil at a price of, $30 a barrel was a bit too cheap, they then came out and, they said, well, we think fair value is at $40. So we're happy to buy 30 and 31 and 32 and 33 and 34, 35, 36, 37, 38, 39, and maybe even 40. And that's what we can see as occurred in this first example, all right? Oil got to a point where it was at such a discount that someone then took the initiative to buy up that market. And as a result, when we see that initiative, we get volume and volatility. So what I mean by volatility in this instance is range expansion. Okay, so we can see the market kind of dribbles, and suddenly we get this real range expansion, real sort of impetus coming in from the buyers. Now, the reason we want to understand when we see this this sort of market context is because, well, one, we definitely don't want to stand against it. Okay, more importantly, we want to be prepared for the point when we see this kind of price action, so that we can actually go with the trend and not counter trend. And so that's why we identify this principle of volume and volatility. Then, key trigger breaks. What do I mean by that? Well, here's a great example. We had the, if you go back to the gold monthly and you have a look back to 2012 when we sort of, peaked at $1,900. For a long time, the market kind of coiled and kept bouncing, off this monthly trend line. Eventually, we had an inside month before we had what I like to call a key trigger break. And all a key trigger break is, it's when the market breaks below a key, whether it's support, whether it's a psychological area, whatever it may be, it's a point that triggers triggers initiation. In other words, big hedge funds, big institution funds come to the market and they say, well, we're ready to take this market lower, and we don't think fair value is at 1500 or 1400. We think it's potentially all the way down at 1350, and they sell it all the way down, and they show real aggression and real intention. And as you can see, again, note guys, we have we had some big candles here, but over the last sort of these almost this entire year, very small ranges, and all of a sudden in 1 month we get huge volume and volatility and huge range expansion. So important guys, another key principle that you need to learn and understand and be able to identify, so that you can then sort of apply your recognized patterns accordingly. Okay, obviously some of the tools you can use, again, Bollinger Bands show wonderful, shifts in volume and volatility, relative volume indicators, average true ranges, and, some of the volatility indexes like the VIX, okay? When you start to see those tools showing, a potential for an increase in volume and volatility, that's when you want to start, leaning in towards this sort of market context. Okay, let's then move on. Paper, all right? So institutional versus technical flow. A lot of people don't understand the difference, but it's very simple, okay? Paper or institutional flow is very, where we see the initiative. We see real big buyers, real big sellers step into the market and be aggressive with the market, okay? Anything other than that, is what I like to sometimes call when the market starts to go range bound or starts to sort of fill out areas or trade between points. That tends to be more technical flow. Now, again, it's important to note and identify the difference, because when there's institutional flow in the market, it tends to have strong continued trends. In other words, we don't want to be fading that. However, when the markets move into a more technical type pattern, we then want to be looking to be trading both sides of the market and really looking for those patterns, looking for those, those opportunities to trade on both sides. So, very important to understand, when there's institutional money in the market, it tends to trend, it tends to be huge volume and volatility, and most important, obviously, technicals don't hold, guys. If ever you're trading a market and you wonder, wow, this really big area that, should have held and it really didn't, that's a sure sign signal that there's real paper, real flow in the market. And the example to use is, if you're trading today or, sort of the back end of last week, if you look at the, the sterling market, or you look at, a lot of the equity indices, you look at the gold market, there's no technical flow in those markets. It's pure paper. It's institutions, hedging, a lot of real market money, real money coming into the market, and not worried about the technical landscape, more worried about just executing orders. Okay, then our next principle. Fundamental flows. Now, most of you should know what this is obviously by the name, but effectively, when there's new fundamentals in the market, okay, we have a completely unique context in the market, and we have to understand that context. Now, the example in mind I'm going to use is obviously Brexit. So at the moment, if you're trading the sterling, you've got to understand that you are in the context of a fundamentally driven market. All right, it's not a technically driven market. So you can be the most amazing technical analyst in the world, but if you're trying to apply a sort of a technical approach to a fundamentally driven market, right, your results are not going to be reflective, or not going to be reflecting like you want them to, simply because you're not understanding the context of the market. So that's the one example I definitely use is right now sterling is in a fundamentally driven market. Now again, when markets tend to go into fundamental fundamental context, we tend to see new trends developing, all right, as a result of new information. We tend to get a lot of trending. All right, so we tend to get when there's central bank intervention, for instance, whether it's a quantitative easing or a change in rate policy, then we tend to see markets sort of moving in a fundamental type context. Okay, and then obviously the example in oil is when we see a huge change in supply and demand. Guys, note when we see that change in supply and demand, we can't sit there and expect our normal way of trading or our normal patterns that we apply to continue to work in the same manner, because the context has changed. And that is ultimately the purpose. This is, I'm going to show you these principles, and then I'm going to show you how to apply a few patterns within these principles. Time, very important. Time is a key function in market dynamics, and every single trade you take on, every time you look at a market, you need to look at it in terms of time. In other words, how long has it taken a market to get from A to B? How long has this taken from the market to shoot up here? How long did this market take to collapse? Okay, where did it come from? Was it a straight line move or was it a slow grind move? Okay, you need to interpret a market's context in terms of time. How long did it take? All right, and most important, did it take the amount of time you expected? And I'm going to show you an example in a minute what I mean by that. Okay, let's move on to that. So this is this is the gold daily, and the reason I use this example is because this is the best way for me to explain the principle of time. Right? Now, we can all see this is a wonderful little flag formation. The market rallied aggressively, and it's now moved into sideways, sort of trending up market. Okay? Now, what we would expect to see, in other words, if we look at this, we can straight away see in this context that the market sort of, when it got to a discount price, notice how little time we spent before the market almost catapulted to the upside. Okay, straight away we can see that, or we can say to ourselves, well, clearly the context of this market is that when we are at lower prices, the time spent at lower prices is very minimal, as opposed to when we are at higher prices, as we can see in this first instance, or the second instance, time, or the market tends to spend a whole lot more time at higher prices. So straight away, we've got to put our hats on and say to ourselves, well, if we're going to be trading a pattern from lower prices, well, we expect to see that pattern play out a lot quicker than what we'd expect to see that pattern play out at higher prices. And that's how we try and, infuse time into our principles or into our market context. Now, let's move on to our last principle, correlation analysis. I'm not going to expect you to know too much about this. Again, like I said to you guys, these principles, we can talk hours on end about each individual principle, but the important thing to understand about correlation analysis is that, flows tend to be allocated across multiple asset classes, at any given point, all right? What I mean by that, well, a hedge fund doesn't come in and just buy the dollar. Okay, they'll come in and buy the dollar whilst selling something else. In other words, hedging out their position. Or a fund manager might come in and, he might be paying a risk-off flow, so he'll sell some equities and buy some bonds at the same time. Now, it's important to understand these correlations because the stronger a correlation becomes, the stronger the trend in those markets become. Okay, so what I mean by that? Well, the example in mind here is the US 10-year and the S&P 500 weekly. Now, if you go back to 2008, during the panic times, right, we can see that there was a very strong positive correlation between the S&P index, okay, and bond yields. Right? So in terms of price, in terms of bonds and equities, there was a very negative relationship, but in terms of obviously yields, there was a very positive relationship. So what does that mean? Well, it means that when the S&P was selling off because there was panic, at the same time, the bond markets were rallying. Okay, why? Well, because at that point in time, there was a strong correlation for fund managers to allocate flows in a risk-on or a risk-off type manner. Okay, so it's important to understand those correlations because if I'm a trader and I see suddenly this correlations developing, remember these correlations remain intact for a couple of weeks and months. So straight away I know if there's strong correlations in the market, then I can come in and lean on other markets, whilst I'm trading my market. So I can lean on the context of correlations to trade my market. Okay. The other example is the gold and the dollar, a very, very good example because this is 2016. Now, as you can see, over the last sort of almost 2 months, there's been almost a hugely negative correlation, almost a perfect negative correlation between gold and the dollar. So what does that mean? Well, it means when the dollar rallies, okay, we see the gold price come off. And likewise, when the dollar sells off, we tend to see the gold rally. Right? So important, guys, because straight away that says to me, if the Federal Reserve comes out and they come out and they say, you know what, we're going to hike next month, or they say we're not going to hike, or we're never going to hike, straight away, I don't need to think too much. I know that based on fundamentals, I know based on the principal context of correlations, that gold will be a very strong buy if, the dollar starts to sell off, and it'll be a very strong sell if the dollar starts to rally. So that's why we use this principle of correlation, because it can almost give us a head start, a confidence in the trade patterns that we decide to take on. Okay, those are our principles, guys. Those are the 8 principles. There's a summary for you. What I would suggest now, take a snippet of it, take a snapshot of it, take a picture of it, and keep that next to you. It's a summary I've created for you guys. It basically just summarizes what we've gone over. And what I want you guys to do now in the next 5 minutes, we're going to take a little break, is I want you to go and I want you to apply all 8 of those principles as best you can, and I want you to apply them to the example I'm going to give you. At the same time, Terry will take a few questions, and if there's anything you don't understand at the moment, don't worry, it'll become a lot more obvious when I move on to the next session. So let's take 5 minutes now, if that's okay with you, Terry, and yeah, there's your example.
Okay. Okay, if you have any questions, go ahead and post them, and we'll ask them here in a few minutes. Hey guys, we're just taking a quick break. If you have questions, please feel free to post them. I'll answer them here in just a minute.
Hi, Terry, you there?
Yes.
Okay, we ready to go again?
Yes. Let me scroll through the questions here. Okay, let's see.
I think the important thing whilst you're looking at the questions is just to say to everyone, this will start to make a lot of sense now when I go through it and when I apply it for you. I think it'll all come together as I apply it for you guys.
Okay. Can you elaborate on the way to determine between paper flow and technical flow?
Okay, so very simply, guys, paper flow. The example we always, taught to our graduates is paper flow tends to be very trend-like. It tends to be very one-directional, and it tends not to obey any sort of technicals. Okay, it's almost a case of, if we use the Brexit example now, if there's a bit of panic tomorrow morning because of a vote that comes out tomorrow, then big institutions that they come in and sell the market, and they're not price sensitive. I think that's the best way to describe paper flow. It's when a participant is not sensitive about price nor time. Okay, so he's willing to take the market at whichever price is because he needs to get that paper, he needs the liquidity. So that's the best way to explain paper flow. Is technical flow is when a market starts to obey certain price levels, tends to sort of almost ping between support and resistance, tends to ping off certain sort of Fibonacci's, or Bollinger Bands tend to work. So it's when the market starts to almost accept value between certain points and trade between those points. So that would be the best way to explain paper flow versus technical flow.
Okay. Let's see. How did you come up with your trading style? Did you learn this at a prop firm?
Yeah, okay, so obviously I was, when I started prop trading, I was taught very basic elements of trading, and then, they kind of gave us the tools and said, on you go, have a crack, figure it out, learn and make lots of mistakes, and really just try everything. And that's what we did. We would click all day. We would literally just keep clicking for 10 hours a day, and at the end of the day, we'd spend 2 hours recognizing what was working, what wasn't working, and then over time, you develop an understanding, or your own understanding of how you want to apply yourself in the marketplace. So that's how most day traders go about it. They don't have a sort of a way of trading. They develop a way of trading over time based on how they understand the markets.
Okay. Let's see. Where did you go? Okay, this will be the last question, and then we'll move forward.
Yep.
How can we use this info to develop a very simple strategy?
Okay, excellent. What I would say to you is wait for the next section. I'm not going to spoil the surprise. So wait for the next session, and you're all going to go, okay, I understand now where this is going. So let's move on, if that's okay with Terry, and then I think everyone will kind of get a really good understanding of how this is going to work. So in terms of practical application, I'm just going to very quickly run through this. Well, very clearly, this is the oil. It's the oil from this year. It's the daily oil. The most important thing is you all know about that wonderful double bottom. Now note the trend. Okay, we can see a very steep trend. Note I've got a long-term, a short-term, a medium-term trend. Right now, obviously, the long-term is to the downside. In terms of a medium-term, short-term. Well, medium-term, we tend to be in a very steep rising trend, whereas short-term now, the market looks as though it's found, it seems to have rallied aggressively and reversed aggressively. So I can see short-term, we've sort of moved more to a little bit of a neutral type short-term trend. So that's how I would identify my trend. As you can see, I've got the trend line in. Right? I note the degree of the trend line. It's very sharp, very steep, which is telling me that this was a very aggressive type trend to the upside. Right? Again, I've got a few more other trend lines telling me how price is distributing, between this 26 and 51. Now, then I can talk about trade location. Where are we trading currently? Well, we're trading currently at very high prices, but very high prices once the market has showed us some very aggressive reversal of the top. So straight away, I can see that, yes, okay, we're obviously coming into an area of support here, but in terms of trade location, obviously, if we take out, this sort of key trigger point here, we could start to see some sort of downside movement. All right. In terms of market positioning, well, right now we've had the steep move up. We probably have got a net short in the market at the moment. So whilst I would expect prices to continue to the downside, I'd be wary of maybe some little bit of a washback, if the shorts become a little bit nervous. Then in terms of volume and volatility, note we are at a potential high. Note how the market has changed suddenly from moving sideways to becoming very volume and volatile. So we can see a pickup in the volume, and we can see a little bit of range expansion. So straight away I'm saying to myself, well, I'm not going to be looking for smaller ranges, but rather larger ranges. In terms of paper versus technical flow, well, at the moment it does look as though some paper stepped in simply because of the way prices responded since we hit that top. However, we obviously did have quite a bit of technical flow in this area prior to the extension to the upside. So what would I expect going forward? Well, I still expect that paper to be there. I would still expect that paper to step in at some point. But right now, it looks likely that we could just enter a little bit more technical trade as the market moves sort of up and down. In terms of fundamental flows, well, obviously, there's a lot of fundamental news with regards to the oil. We obviously get the EIA and the oil inventories every Tuesday and Wednesday, as well as obviously all this talk about oversupply and the Canadian fires and the war in Nigeria and all sorts of things. So again, there's a lot of fundamental, but right now the key fundamental is this oversupply theme in the market. Okay. In terms of time, well, I can see that the market quite whilst it did go up, relatively steeply, it sort of has done it over a period of almost 3 or 4 months, okay, as opposed to just doing it in a straight line. So what that does suggest to me is whilst, prices have gone higher, it wasn't sort of a convicted, convincing type buy. It was more sort of a two-way grind higher. In terms of correlation analysis, well, if I had a correlation up here, I would make sure I understood what the correlation of oil was to, say, the dollar. And as a result, if you do know that correlation, it's actually quite low. In other words, the oil market late last year was highly negatively correlated to oil, whereas this year it's far less. In other words, oil is no longer determinant in the price of the oil. So that's how I would apply myself in terms of the context. So I would take these 8 principles, I would write down a whole page of trade location, positioning, volume volatility, and I would get a very good understanding of what my context is. Then, and this is where we move to, then what I start to do is I start to identify my patterns that I already know. So this is theme number 4. Now stick with me. I'm gonna work with this now, and I'm gonna work you into the next section. So candlestick patterns. You should all know these. I'm gonna go quite quickly through them. The first one is an inside day trend continuation. What is an inside day? It's where today's range is inside the previous day's range. Okay. Once we tend to break out of that inside day range, we tend to then get some form of continuation. Now, that's a very basic candle pattern. Our next basic candle pattern is where we have these tail support and tail resistance. So we can see the market came up here, got very aggressively rejected, came back here, and then obviously we had this very aggressive tail, and we then should have extended. We tried to extend, but obviously failed, and the market backed off. So again, tails are very identifiable candlestick patterns. Then our last candlestick pattern is an engulfing candle. Very simply, it's where the following day completely engulfs the range of the previous day. So it shows us very sort of, almost overpowering from one side, whether it's the buyers or the sellers. So what I'm going to do with you now is I'm going to take you using these 3 patterns. So what we effectively do now is we have a whole bunch of strategies. Call them, 20 to 30 plays, whether it's pattern recognition, whether it's Fibonacci retracements. It doesn't matter what it is. We have all these plays, and then we apply those plays into very specific market context. Okay, so let me repeat that. We have a play, whether it's an inside day, a tail break, or an engulfing candle, and we apply those only into a specific set of context in the market. Okay, and that's where the power comes in, guys. That's the crux of it, is that we take the patterns, we develop the patterns, we don't apply those patterns into every situation, because if we do that, we're not interpreting and understanding market context. Whereas if
Brannigan,
we first interpret, yeah?
Hey, what slide are you on? We're still seeing the WTI oil.
Oh, sorry about that. Why is this not going? There we go. Sorry, guys. Sorry about that. Okay, let me quickly go back over that. All right, so there's our inside day trend continuation.
There we go.
Okay, so we can see there's our inside day there. We have our inside day, and then we have the continuation candle. Okay, so that's our first basic candle formation. Then we have our tail, so we can see a nice little tail there. The market backs off, comes back a second time, and once we take that out, we should extend as we get the stops. Okay, we don't, we back off again. Right, so that's our second tail candle formation. Our third is what we call an engulfing candle, where the previous day is fully engulfed by the next day, and we then see the continuation. So what I'm going to do now is, and it's so important, guys, these are 3 patterns I just completely plucked out of the air because they're well-known patterns. But any one of your setups, doesn't matter what it is, whether you trade off moving averages, Fibonacci's, it doesn't matter. Every single one of these tools has power, but it has more power when it's applied within specific context. And that's what I'm going to show you now. So sorry about that. So you're all good with those 3 patterns. You can write them down if you want, but I'm going to show them to you now within context. Okay, so let's move on. So what we're going to do now is I'm going to take those three patterns and I'm going to show you how they would be applied within the E-mini S&P 500 index. So what we've got here is the S&P 500 weekly candle chart. Now, we know that straight away, okay, yeah, my principles at the bottom right, we can see what the trend is, the trade location, market positioning, etc., etc. We then want to go and apply. So we first develop the market context, and then what we go and decide is where would our three candle setups, whether it's the inside day continuation, the tail support and resistance break or continuation, and engulfing candle, where would those trade setups best be fitted within the context of the market? Now, the first example I'm going to use, as you can see in the middle of this profile, so if we could take the E-mini S&P over the last 2 years, you can very clearly see that whenever the market is located within the middle of this wide range, over there, over there, over there, and over there, every single time we tend to get very directional flow, and directional flow, directional flow, directional flow. Every single time the market is trading in the middle of the range, okay, on market position or trade location within a sideways trend, we tend to get very volatile and volume-driven flow. So if we had an inside day setup, okay, whether it was at any point in this 4-week range, if on the daily candles we had an inside day, we would be wanting to trade that pattern very aggressively. Why? Because the market context is telling us that there is a high probability that you're going to get very aggressive fast money moves within the middle of the range. Okay, so do you see what I did there, guys? Very important you understand that. Let's try it with the next one. Okay, let's move to the engulfing candle. So again, what we would do is we would try and identify, based on our trend, location, positioning, volume and volatility, and all these other principles, where would an engulfing candle most likely give us a high probability opportunity of success? Now, note, we can see that based on the trend of this market, it's moving sideways, based on the fact that, prices are coming to higher and then they're just sitting. So they're sitting for a long period of time at higher prices. It's very unlikely, remember, an engulfing candle by nature is very aggressive. It shows us intent from a buyer and seller. So you have to say to yourself, is it likely, is there a high probability that in a sideways market that's not moving, that's spending a lot of time at higher prices, is there a high likelihood that sellers are going to be very aggressive and show intent at higher prices? And the simple answer is no. Okay, and that's not me looking at a chart getting a bias. That's me looking at a chart saying, well, I can very clearly see that no one wants to take, sort of impetus or initiative at these higher prices. Okay, so if there is some form of an engulfing candle, like we get in this example here, you can see that, yes, there was downside. Okay, but note, guys, note how, a real engulfing candle should look, a lot more aggressive, in its intention. In other words, we should see very quick and aggressive follow-through as opposed to what we got here, which is more sideways trade. Okay, so you understand what I'm showing you guys there is that, by taking the context of the market, we then go and say to ourselves, where would we best want to apply our 20 or 30 or 40, whatever trade setups we have? The last example is tail support and resistance. So straight away you've got to say to yourself, market context is sideways. When the market is at higher prices, we can see that there's very little impetus from the buyers to be aggressive. Equally, there's very little from the sellers to be aggressive. So we're very unlikely to see any kind of tail side resistance up here. Right? And what we can see is when there is some sort of tail resistance, notice how the market has respected that. Okay, equally from the support side, note the difference in tail support. So when the market gives us tail support, it tends to be far more aggressive from the buy side as opposed to the sell side. So straight away you've got to say to yourself, if you are looking to take your trade setup, playing for these, very aggressive doji reversals, well, you're going to have far better luck of doing it from the buy side as opposed to the sell side. Okay, more importantly, guys, and this is the clue, and this is where context is so powerful, if we come back towards this buy side, these really aggressive tails, and we suddenly start to take those out, that's telling us something very unique about this market, which is that, that aggressive buying has now disappeared, and we could start to enforce some very aggressive trigger point type strategies into this market. Okay, so that's how we apply it, guys. We take the context, we understand the context of our market, we interpret where would be best to sort of put our patterns, or our recognizable patterns into the market. Where would be the best point to allocate those patterns that's going to give us the highest probability of success. Another example. Okay, again, same thing. This is the gold, and it's the gold from this year. Now, what we're going to be looking at, again, we determine trend, trade location, positioning, volume, volatility. Straight away, you can see that our inside day trend continuation, notice how the inside days tend to be happening and occurring very aggressively in the gold. So we've seen 1, 2, 3, 4, almost 7 inside day trades this year. Okay, now note, where is the trade playing out best? Well, straight away we can see, based on our context in an aggressive uptrending market, we can see that the inside day trend continuation is occurring better when we're at lower prices, okay, as opposed to, note, higher prices. So at higher prices it tends to fail. At higher prices it tends to fail. At lower prices we tend to sort of fail. Okay, then when we get to low prices, we tend to move to the upside again. When we get to the higher prices, again, note the lack of impetus, guys. So inside day breaks, so let me just rephrase it. Inside day breaks are trend continuation patterns. Okay, so note that trend continuation is occurring better when it occurs at lower prices as opposed to higher prices. Okay, you all understand that. So that's the first application of our candlestick pattern into our context. Then, again, note our tail support and resistance. Okay, where are those tails coming in? Well, they're coming in aggressively from lower points. From the higher points, again, note how there's a lack of aggression. So straight away, we can identify and say to ourselves, well, if we want to be playing for one tail support and resistance, well, we're better off playing it from the lows. Okay, more importantly, we want to be playing the breaks of those tail support and resistance when we are nearing higher prices. And again, guys, that is nothing more than a result of us being in a very strong uptrending market. So note, we're using the context of the market to tell us where our candlestick strategies will be best employed. And then obviously our last one, our engulfing candles. Note, again, note the engulfing candles that occur at higher prices. Okay, note how it fails and actually gets rejected. What happens when they're occurring at lower prices? Well, we get the engulfing candle and we get the continuation. Okay, again, note what happens when they happen at lower prices. We get the engulfing candle and then we get the aggression. Okay, so straight away we can say to ourselves, clearly in an uptrending market, when trade is located at lower prices and there's a specific type of positioning, we tend to see engulfing candles working better from lower prices as opposed to higher prices. So straight away, guys, just using these basic examples, using 3 very, very simple, candle patterns that everyone knows about, you can develop a very simple strategy and say to yourself, well, when we are in a strong trending market and the trend is, upward in the medium term, long term and short term, if I see an engulfing candle, well, I want to be very aggressive and playing for the continuation of that pattern when price is trading at a discounted area or a lower area. Okay, you all understand that, and that's how we apply it, guys. That's how we take basic setups and apply them within the context, not the other way around. Not the biggest mistake retail traders make is that they say, well, I have an engulfing candle, therefore I do X, Y, and Z. Okay, then, they get results and the results say, well, 30% of the time you're right, 70% of the time you're wrong. They blow up their account and they never achieve anything. And they wonder, well, why do these engulfing candles sometimes work and why do they not sometimes work? And that is the entire crux of this whole webinar, is to show you that they work sometimes because they're in some specific set of context. They work most of the time when they are in an applied set of context. The times they don't work is when you are applying them within a context that doesn't agree or doesn't make sense to that specific pattern. So those are 2 examples of application. Now, what we're going to do is we're going to talk a little bit about order flow now, and I'm going to move towards the back end of this webinar now, and just explain a few little other tools you guys can think about, you can use, to add value to this idea of context. And what I'm going to do then is I'm actually going to show you a short video where I'm going to start you off with context. I'm then going to show you the trade pattern, and then I'm actually going to show you the execution live on the ladder. So very important. What is order flow? It's just it's a tool. Where you can see the entire depth of the market. You can actually see the physical, volume being traded at each price. Now, you can think of this as an auction, guys. Imagine standing in a pit, and you have buyers and sellers, and they're all shouting at each other, and creating all sorts of commotion. And effectively, all you're seeing is that you're watching the physical volume trading at each price and auctioning at each price. Now, why do we use this? Well, it gives us an edge. As day traders, it definitely gives us an edge because we can pick up on specific patterns, that allow us to identify, very good trade opportunities. And obviously, I know Jigsaw has a very good program on this if you guys are interested. So they do talk a lot about this being a part of a trading strategy. In terms of what we're going to talk about, well, the first thing is sorry guys. So the first thing is we need to talk about the context. So what we have here is the WTI oil. Now, what I'm going to show you is we had a 6-month swing high at this 50.21. Now, if you follow me on Periscope, you would have heard me, harping on about this trade for a long time. As we can see on the dailies, the market respected that area the first time it came up and finally punched through it on this day. Now, straight away, I've got to say to myself, well, the context of the market is that, one, we're approaching, a market that is no longer rejecting higher prices. The net positioning of the market is net short, and in terms of the trend, well, the short-term trend is very firmly to the upside within a bigger down-term trend. So straight away I apply all my context to the market and I develop a strategy of I want to play for a break of this 50.21, trigger some stops, and then get out of the trade. Now, the short-term time frame I'm going to show you, this is a 1-minute chart. As you can see, the market came up to this, this 21 area, and the first time it actually backed off. So it respected the area, and what I'm going to do is I'm going to actually show you the video now and show you how we would have executed this trade with a big term context, and then sort of applying a specific trade setup. Now, the short-term trade setup or the candle formation that I've been showing you is that I want to apply some form of a sort of almost a flag type breakout where the market sort of aggressively moves. We can see the higher low formed. We can see the market sort of almost accumulating a position, readying itself to take out this key area where a lot of sellers are going to look to stop out of their position. So let's get into that video and see what it'll look like. So yeah, we have the video. Let's play this through. I'm not going to talk too much. I'm just going to kind of show you where the pinch points are. As you can see, same sort of flag formation here. And let's see what happens now. So remember, our key area is at 50.21, and that's the key where we expect to see some stops. So on the left side here, you can see that's the WTI oil. Note again, the 50.21, that is effectively the area where we expect to see some stops. So what you're looking at here is nothing more than an auction process. We can see the market's currently trading this price of 50.16, and on the right here you can see the physical volume trading over every price. Now, what we're looking to do, okay, we're actually looking within our big context, we're looking to buy through that area of 50.21, trigger some stops off, and ultimately, take profit once all those, shorts have bought out of their position. So again, note guys, we're not trying to force our way into the market. We're not trying to force a view. What we're trying to do is we've got our little bit of our candle formation. We understand the context of the market, and we're now looking to enforce a pattern within the context of the market. So let's have a look what happens once this market gets up to those 50.19s, and we can see sort of the aggressiveness of the market. So note, we can see a little bit of buy-side flow coming into the market, and note there straight away, if I was to pause that, market takes out the 21s, and straight away it trades up to the 37s. Trade is gone now, stops out, taken whatever it may be, sort of 17, 18 prices out of the market within a matter of seconds, and that's the trade, guys. That's the trade done, completely finished. We don't need to do anything else now, but sort of, relax and wait for the next opportunity. As you can see here, note the aggressiveness, guys. Note the stops going through the market, and that's what we're after. That's what our objective as a day trader is. Sometimes we want to take some short-term stops. Sometimes we want to sit on trades for a few days. Sometimes we want to sit on trades for a few months. It all depends on the setup we have, but more importantly, that setup within the context of the market. Okay, let's get back into it and let's talk about a few other interesting things. So, let's go back down there. All right, so to bring you up to speed now, we've applied, we've shown you a video. Now, let's talk a little bit about risk reward. So again, why do we want to use this methodology of context? And this applies a lot to the retail market. Okay, it's gonna increase your probability of success, 100% guaranteed. If you just take a few basic elements of context and you apply them to your current strategies, guys, you're gonna see your probability of success increase dramatically. Right. More important, if you have context, well, you can start to you can almost take your patterns and start to almost pinpoint them to a very specific market context. So you can kind of say to yourself, well, I've got this trade set up of a Fibonacci retracement of a 38.2, and I want to only apply that when a market is in a trending formation. And suddenly you can go and you can take 9 or 10 different markets and apply this one principle or this one setup within your definable context. Okay. More important, you can reduce your risk factor, guys. So important. You can reduce the risk you're taking on all your trades because suddenly you're now trading with very identifiable, understandable risk. Okay. So in other words, you know where you're wrong, and if you know where you're wrong, it's going to make your outcome of your trades far more powerful. Okay, your scalability is going to improve, and very important. What do I mean by it? In other words, you can start to become very much bigger in your trade simply because no longer are you going to be losing or winning 30% of the time. You're going to be winning far more often. So straight away you can start to become more scalable as you become more confident in your trade opportunities. Right. And very important, as I said, leverage is the art to successful day trading. Guys, if any of you want to know what the secret to day trading is, and don't tell anyone this, but it's about using leverage effectively. In other words, we know sometimes when to get big, and we know sometimes when we don't want to be big. If something makes sense to us, if the context lines up and the pattern's there, we get big and we leverage and we take advantage of the higher probability opportunity. When it's not there, which is, a lot of the time, we just sit back and we just play around. We just feel the market out. All right. Again, obviously, pyramiding becomes possible, guys. So you know when to get big. Again, with contextual trading, you always know where you're wrong, guys. It's so important. That point where the context is no longer valid, that is where you're wrong in a trade. And for example, like I said, if you get an engulfing candle off a trending market that's trending up nice aggressively, and you buy it in the right area, and all of a sudden, it comes back to the, where you entered, straight away you've got to be saying to yourself, well, the context of this market implied that this trade should work relatively easily. Yet it hasn't, and straight away the context is going to guide you to stop out and actually almost save yourself from unnecessarily taking losses. So it really, applying context is going to change your risk reward tremendously in your favor by reducing your risk, but ultimately giving you, you're going to be winning a lot more often. Then the future of trading and the power of trading context. So again, guys, I'm just going to, this is kind of where we're going to get to now, towards the end. Edges are few and far between. Okay, it's no secret. The last, I've even seen it in my very short career that the edges are a lot fewer than what they have been. When 2012 was a fantastic year for opportunity. 2013 was a little bit, it wasn't as good. 2014 was dire. 2015 there was patches of it, and this year is kind of there's not been a great deal. So you need to understand that the edges they're becoming fewer, but they're not necessarily. There are a lot of edges. They're just changing, and that's the important thing to understand, guys. Is that the edges are changing, and that's a result of obviously. There's far less paper in the markets. The markets have become a lot more data dependent because of QE. The volatility kind of is never there and then suddenly comes. There's just so many different, strategies being employed, and obviously automation. So what you have to understand, guys, is that context allows us to always have an edge. Okay, context will never die as an edge simply because it's always going with the market. It's always forward-looking with the market. Okay. Again, obviously, note the game's more systematic, guys. So just understanding that is a form of context. Understanding that markets don't move in straight lines as much as they used to. Straight away, you're starting to employ a form or a principle of context to your trading. Then, multiple market trading, guys. This is where it is now. This is where trading is going, is that you need to sort of have your principal context of a market, have your trade opportunities and apply those to multiple markets. So take one or two setups that you understand, very simple setups, and apply that to multiple markets where the context aligns with the setup. Okay, so important. And then Again, if someone taught you the edge, guys, it's depleted. I can tell you right now, if you're sitting there with a load of strategies and someone showed you those strategies, I can promise you now, probably everyone knows about their strategies. And that's why contextual trading is so unique, because you're going to learn to develop your own edge, okay? You're going to learn to develop a unique edge that no one can take from you, that, no one can ever steal from you, because it's your own art form you've created for yourself. Okay, again, yes, trading is a context art form. It evolves with the market. It's current, it's not lagging, it's forward-looking, it's non-biased. You can apply it on any time frame. So important there, guys. You can apply contextual trading to any time frame, and that includes 1 minute. I'm going to say that, but that includes 1 minute trading. Okay, it gives the retail market a real opportunity to develop, as traders and break even ultimately. All right, and then this kind of summarizes, guys, why it is the future of trading. Is that you can show a man a trade, and he'll eventually blow up. But you can teach a man to trade using context, and he'll develop his own sustainable strategies. And that's the crux of this. I'm not going to give you my strategies, because at the end of the day, they are applied to very specific context. Whereas if you go and learn context first, you'll be able to apply your own strategies to those contexts, and ultimately become very successful day traders or even retail traders. Okay, so that's a summary of it, guys. If I was to summarize this entire webinar, the Holy Grail, guys, it's nothing more than an application of your own recognized patterns within the provided context. Okay, so learn the context. Learn. There's multiple principles of context. Learn context. Take your strategies you have now and just apply those strategies to very specific context. And all of a sudden, you're going to have the Holy Grail. It's as simple as that, guys. That is the secret to trading. It's just being dynamic enough to apply your setups into very specific context. Okay, I just had a little bit of fun here. Verb, don't enforce your patterns onto context. Okay, that is what the retail market does. That is why the retail market struggles so much, because they learn patterns and they apply them whenever they see them. All right, like a donkey do, donkey see. That's never going to work, guys. If you've been in this game long enough, you know that by now. You have to apply it to the context, not just apply it when you see it. All right, and funny, the source of that wonderful quote was some unknown day trader. All right, what we're going to move into now, obviously before I hand over back to Terry, is, if you want, I do tweet quite actively. Most of you all know that. Follow me on Twitter. I'm going to make you aware of some interesting opportunities. Just keep you aware of certain things that are moving. As well as obviously at the moment, I do a few periscopes. Every week I'll be doing a weekly periscope on structure in the market, opportunity in the market. Just little things that you could maybe learn from me. So join in those periscopes, interact with me. I do tend to have a lot of fun doing those periscopes with the guys that follow me. And then of course, guys, if you have something you want to ask, if in the future, I mean, obviously we're going to be, there's loads of sort of seminars we'll do and coursework we'll do. If you're interested, feel free to email me. If you have a burning question you really want to know, okay, there is my email address. Other than that, yeah, I'm going to hand back over to Terry, and hopefully we can answer some questions.
Okay, sounds good. What was the platform you were using?
Okay, so the platform is Trading Technologies, and it's one of a multiple of front-end trading options. So again, there are multiple ways to trade what we call at-the-market trading, and yeah, that was Trading Technologies.
Okay. What does one time framing mean?
Okay, very simply, one-time framing is a candle formation where we effectively see we see very little overlap of candles, but we effectively see a constant higher high and a higher low candle formation. So if I was to sort of almost annotate that, we'd see one candle, and the next candle will kind of start somewhere in the top region of the previous and have another up move, and then another up move, and another up move, and another up move. So we never effectively see a previous low taken out, or at least we never really see the previous range really being tested. So the market just one time frames in one direction, and it tends to show us control in the market, so whether from bias to the upside or sellers to the downside.
Okay. What role does market profile structure have in your contextual analysis?
Okay, brilliant question. Market profiling is a fantastic tool. It's probably my most used tool. I develop most of my context using profiling, and where profiling helps me a lot is, one, it gives me a very early clue when a market is balancing as opposed to a market trending. So that would be my sort of big major context. I could straight away, see on a day within the first hour and a half of trade whether or not a market is showing characteristics of trend or showing characteristics of distribution. So if I can see that and identify it early enough, I can put myself in a contextual frame of mind where, if I can see a market's trending, well then I want to employ some very aggressive momentum type candle formations. Whereas if a market's moving sideways, well then I'm going to start looking for, a lack of momentum or failed break type candle extensions or something like that. So I first identify the context using profiling, and thereafter I employ various strategies into that.
Okay. Do you use market profile or volume profile?
Okay, I use volume profiling,
Okay.
and again, it's simply because market profiling originally was created back in the day when volume wasn't such a, or at least 24-hour sessions wasn't such a big thing.
Yeah.
But now with the 24-hour sessions, using volume instead of just normal TPOs allows us to effectively just see where the volume's being traded. So. But if anyone is interested, there's we will be doing a course at some point on the market profiling. So if they want to learn profiling, it is the #1 tool across all prop. There's not a prop house that doesn't use profiling. So if you don't already use profiling, send me an email. I can send you a couple of details. But profiling is a hugely important tool for developing context. If you like the idea of context, profiling is a wonderful way to develop context.
Okay. How long before you settled with this approach?
Well, I'd say it probably took me 3 years to understand like this big picture approach. I would say I've never really heard someone talking about an approach where you have trading strategies but you apply them within context. I think people have always kind of said, you want to see certain characteristics for a strategy, or you want to see a strategy play out in a certain way, but I don't think people have ever tried to employ strategies within a unique context. And I think that took me a lot of realization to sort of come to this understanding. It's not something I kind of woke up the one morning and went, aha. It developed over time, and now it's ingrained in me. Whenever I look at the markets, first and foremost, anyone who follows me on Periscope, they'll straight away see I always talk about context first. I'm not worried about the price going up or down. I don't really care about that. All I care about is what is the context, and then what strategies can I employ within that context. So yeah, I would say it probably took me 2 to 3 years.
Okay. And I'm just going to add a little bit there. Personally, for me, I like this webinar a lot. I like a lot of what you've been saying, because it reminds me of my own personal trading, and I built my strategy based on a trading pattern working or failing, and I had two ideas. If it worked, then you trade it this way. If it failed, then you trade it this way. And so a lot of this I kind of agree with, and I see a lot of the stuff that I kind of went through and the same kind of mindset, but you made it sound a lot prettier. So, so thank you for that.
Thank you.
Let's see. Can you give us a daily process, or can you give us your daily process of market prep and review? Just kind of a rundown.
All right, well, obviously I trade the European session, so futures open at 7 a.m. Typical morning, I'd be in the office at 6:15. The first thing I do in the morning when I wake up is I look what Asia's done. I'll straight away read through the news. I'm quite a strong fundamental trader, so I do like to understand the news. But then I've got a template, so I have an actual template next to my desk that I fill out every morning. And what that template allows me to do, it allows me to almost have a set approach to interpreting the market as it is. So basically it allows me to almost have if the market does this, I do this. If the market does that, I have that type approach. So it allows me to develop my context early, and then what I'm looking for over the course of the morning session is I want to have certain strategies. In other words, if my context is that, you know, we could see some momentum because there's volatility or there's, you know, flows in the market, then straight away I only want to be trading certain patterns within that context. I don't, you know, I don't want to be entertaining fading opportunities, for instance. You know, even if there's the most glorious candle there that says this is a fade, I'm not interested because it's not within the context. Okay, so that's the important thing, is that it straight away almost, you know, that trade might work, yes, but that trade is not going to add longer term, you know, success to me. It's gonna fail more often than it's going to work, and that's why I don't take it. So then what I do is at midday, I'd draw myself away. I'd kind of have a look where the market, you know, where it's played out, what it's done, and most important, and this is something I urge a lot of traders to do, you know, at midday, in the middle of the day, you know, give yourself a pat on the back. You know, write down what have you done well today. What have you actually, you know, have you identified the context, and you know, has the market played out according to context? If it has, and you haven't made money, excellent. You've done a fantastic job, because your understanding and your reading skills of the market have been excellent. All right, the making money part will come. Okay, anyone can learn strategies. Anyone can learn a set of tools to apply to context. What not everyone can do is learn in context. So just, I urge you, focus on context and pat yourself on the back when you understand in the context. Then obviously trade the afternoon session, get to the end of the day, and then obviously I do an hour debrief every single day. That debrief will, you know, focus on the patterns that worked. It'll focus on my areas. So, you know, I stress this a lot. You know, where was I bad today? Where was I weak? You know, where was it in my risk management, my trade management? Was I gambling? Okay, I tend to be a very excitable trader. I tend to, you know, even with all this context, I still tend to sometimes go, oh well, I'm going to click anyways because it's fun. So I tend to focus on my areas. Where could I have been better today? After that, then I focus on my positives. You know, what did I do well today? You know, how was my mindset in the day? You know, where did I manage to get big in trades? And I think that, again, like I said, that's an important aspect to day trading, is how can I get big, where can I get big, and did I get big? You know, if I can do that, you know, then ultimately I'll have a successful day. But the most important thing, you know, in my debrief at the end of the day, I'm not concerned about the number. If it's green, if it's red, if it's zero, it doesn't matter. What matters is, how was my process over the course of the day? Was there a good process that I can come in and apply again tomorrow? Because if I do that day in, day out, at the end of the day, eventually I'm going to get good at what I'm doing. So that's kind of how I would approach a day.
Okay. Let's see. When you're looking at fundamental flows, are you going in with the mindset of expectations, or having done some scenario analysis, or just wait and see how things develop?
Okay, so I think the best way to answer that is with an example. All right, so let's take, for example, the whole Brexit thing now. All right, we can clearly see right now that, you know, the context of the market is that there's a little bit of fear, and there's quite a bit of pricing going in for a potential Brexit. Okay, so we can see the sterling at the moment is coming under some significant downside pressure. So straight away, contextually, there is no chance in hell I'm entertaining a buy. All right, and not because it might not go up. Of course, there's two-way trade. Of course, the market's going to bounce. Right, but for me, based on the volume and volatility and the context and the, you know, the trade location, etc., I do not feel there being good risk-reward measures for me to take on any long-side trades. So straight away, I'm almost leaning towards rather trading one side of the market. Okay, and what I'll typically look to do then is I'm applying that fundamental, but then I'm looking for very specific fundamental type flows. So for instance, yesterday, right, we had the latest poll, and, you know, obviously we waited all day for that poll, but what I was looking for is the whole day I waited there, and I was looking effectively to take short side trades if the market, in other words, if the poll came in for the Leave campaign to have increased. Okay. Likewise, if it came the other way around and the market was sort of saying, you know, there's a higher chance that we won't leave, I was looking, you know, to effectively not initially buy the first move, but maybe even look to sell into some kind of a move. So still remain within the context of the move. Okay, if that kind of makes sense. So what I would do is I would always trade with the fundamental. I wouldn't trade against the fundamental. And then what I'll do is I'll apply certain strategies within that fundamental.
Okay. Let's see. Can you see paper flows better on a price ladder?
Yes, of course you can. I could show you a few examples. Again, you know, if you've been following me for a while, I tend to show a lot of yield paper flows. So, because I'm a bond trader, I tend to show what what yield levels look like and when paper enters the market. What I will say is, typically, I'm going to give you a little illustration, but in terms of a pattern, paper will tend to look, on a faster term time frame, a little bit like a V distribution. What do I mean by that? In other words, if you look at a chart and we get this sort of V shape where the market very aggressively moves lower, but then in an equal and opposite time frame, so if it took 4 hours to move aggressively lower, but then took 4 hours to reverse the entire move, that tends to show us when papers entered into the market, or at least influential, traders have entered the market. So when I see that sort of a price response, I then tend to look to favor trading that market, obviously back up towards the upside if we get that V shape. So if you want to learn paper trading, I would say looking for that very specific pattern of a V reversal or an inverse V reversal, that's a very good way to sort of try and interpret when papers enter the market.
Okay. Do you include order flow reading skills as one of the skills to acquire along with reading context to be able to survive and thrive in today's markets?
I would say instinctively, no. I don't think you have to have price action skills. However, what I will say to you is that I think given that the edges of trading are diminishing from a pure technical perspective, I think those edges are becoming less and less. And I think that if you can add the tool of reading price action and being able to interpret when paper steps in, or when there's a big fundamental in the market, or when there's a lot of absorption or two-way trade or reloading, I think if you can have those skills, it's only going to add value into your context. And what I mean by that is if you go back to that video I showed you, right? One, I'm using the context, which is the big picture, which is what I think the market might do at a certain point. Then I've identified a specific pattern within that to trade. But then last but not least, I've used a very specific kind of price action to actually execute that trade. So all three together marry into one very, very a big confluence of opportunity. So I wouldn't say it has to be, but I would say if you can add the tool of price action trading, I think you can be a huge successful day trader for sure.
Okay. Let's see. How do you rate the Jigsaw platform, or what do you think of the Jigsaw platform?
I think, okay, so I've spent a brief amount of time with the Jigsaw platform, and I think the basic premise of what the Jigsaw platform is offering is it's very unique. I think it's very good. I think it's focusing on the right elements of day trading, which is order flow and price action. And I think for anyone that wants to learn price action, I think it's a very good program to go through. So I would definitely say to anyone, if you're wanting to learn price action skills, 100%, yeah, I think Jigsaw has a very good program for that.
Okay. At the beginning, you mentioned looking at weekly and daily charts, but your video example was of a 1-minute chart. Does that suggest that you are personally happier trading a shorter time frame?
Okay, so what I would tend to do for me, I always do a top-down analysis. So I would go, at the beginning of a week, if you watch a Periscope, I'll always start weekly, daily, and then I'll move on to 60 minutes. So I combine all my time frames to develop my context, but then when I'm executing, I only use a 1 minute for my patterns. Okay, so I'll have patterns on 1 minute, I'll have patterns on 5 minute, on 30 minute, and various patterns will be better suited on various time frames. Now, what do I mean by it? Well, breakout patterns where I'm looking for stop execution. There's no point in me using a 60-minute chart because I'm behind the curve then in terms of that price, in terms of that pattern. So for a breakout or for a stop hunt, I'm going to have to use a very short-term time frame. Otherwise, that trade's not going to be effective enough. So again, it all depends. The most important thing I want to say to everyone listening is don't change your strategies. Keep your strategies. Keep these little unique patterns you've used. Keep that. That's powerful. That's potential profit. But learn context and learn to apply those patterns into the context. That way, you'll make your strategies far more powerful and far more effective.
On a practical level, how do you remain solvent while learning in the early portion of your trading career?
Okay, yeah, I think that's a very, very pertinent question, actually, and what I am going to say is, to be honest, it's not easy. Trading futures nowadays, unless you've got I'd say you can learn. trading, spreads, but you have to accept then, if you're going to be spread trading, that there are certain limitations to spread trading. For me right now, I mean, the cost of trading or the barriers to sort of entering the way prop trades are coming down tremendously. There are a lot of very good brokerages out there now that are offering you opportunities to trade the way we do at a reduced cost. But it's not easy, guys. I'm not going to pretend that, I mean, a $5,000 account is probably not going to sustain you long enough. However, like I said, you have got, products now like mini DAX and, mini euro dollar contracts.
Yes.
So, with the birth of those contracts, I think it's gone from, the days when you had to have at least $20,000 to, maybe $5,000 might actually be enough now for you to learn. So if you're willing to stick it out and really grit your teeth and actually physically learn a real strategy, yeah, I would say your best route is to go with the mini contracts. That, I mean, they've only just recently in the last couple of months become available, so that's definitely a route you can go.
Yeah, and I agree. Like when I first started trading, I personally trade the mini 6E.
Okay.
I absolutely loved it. It was an easy way to trade and learn how to trade and risk the least amount. It's like a $125 margin and $1.25 a tick, and you can
makes it far more effective. Yes.
Yeah, and you with $5,000 you can take multiple losses day after day, and it won't kill you.
100%.
Yeah.
I think the big thing is and this is the mistake where a lot of new traders go, is that they you got to almost think of trading account as a poker table. You've got to be able to sustain almost 100 trades. I'd say a minimum of 100 trades. So straight away you got to say to yourself, is your strategy going to allow for you to take 100 losses in a row? If it's not, well, you're better off than employing that capital elsewhere. You might as well go and do something else. There's no point, if you're undercapitalized, there's no point in even starting. So, don't change your strategy, guys. Change your capital, get some more capital. That's going to be the best route for you, is be as liquid as you can.
I agree. Okay, how does market context compare with market structure?
Okay, in effect, market context is the same as market structure. Okay, bear in mind, guys, the principles I've showed you tonight are not the only 8 principles. Okay, market context is the same thing as market structure. They are one in the same thing. It's just context is probably used in a more sort of a very I would say condensed role. So for instance, if a market is moving in a sideways range, but the range is becoming narrow, you'll hear day traders talking about sort of the market's prepping for a move. The context of the market is showing us we're going to have a break one way or the other. So again, that is, we were applying certain principles there, which is volume and volatility, trade location, etc., etc., etc. But we're then using a very condensed area that we would call context to then develop a strategy for a break one way or the other.
Okay. Simple question. On average, how many trades per day do you usually execute, and what kind of risk reward do you use?
Okay, so as a day trader, I can be quite active sometimes. I would say sometimes I can be 20 to 30 unique trade opportunities. But bear in mind, guys, I'm doing a lot of trades where I'm taking one tick out of the market. I'm doing the role of a computer program. Because I've identified an opportunity that a computer would take advantage of. So I could do 20 to 30 trades a day. And sorry, what was the other part of the question?
I deleted it.
Sorry.
And what kind of risk reward do you use?
Okay, so again, guys, with day trading and when you're trading with liquidity, I almost want to say get the idea of risk reward out of your head. I know that kind of almost goes against what I was showing you, but for me, trading is trading is gone. The days of taking 3-to-1 and 4-to-1 risk reward, that's a fallacy, guys. That's what they write in the textbooks, and that's what all these courses tell you. That's not real trading. Okay, real trading is I'm taking 1-to-1. Sometimes I'm taking 1-to-2. Sometimes I'm probably going to have to go 10 ticks aside to take 5 ticks. The important thing to understand is that it's not so much about the risk reward. That's not the important thing. The important thing is the probability of success, the probability of certain outcomes occurring. So if you're going to go 1-to-4 risk reward, but the probability of success is 90% of the time, that's a good trade, guys. In the long run, that's going to make you money. and that's why we do those trades. So again, don't focus too much on risk reward. Focus on where's my risk, where am I wrong, and ultimately what should I be achieving out of this trade.
Okay, I'm going to combine these last two questions to one, and then this will be the last question. Do you use predetermined profit targets and stop losses, and how do you determine those if you use them?
Okay, so in terms of the ultimate question, managing risk, what I would say is, guys, remember, we are the masters of risk management. That is our job. It's to manage risk. So the most important thing I always start with is a stop. It's very, very simple. I stop where I'm wrong, or sometimes where the risk manager says I'm wrong, but more often than not, I stop at the point where my concept or my trade idea is no longer valid. So what would be an example? Well, if I have a flag and I'm playing for a breakout continuation momentum flag break, right? I do not want to see that momentum disappear. The minute that momentum disappears, okay, the trade is no longer valid. Therefore, I'm no longer in that trade. It's not a case of, well, I'd rather get hit and be proven wrong. That's not what we're here for. We're here to trade a very specific pattern within the context we understand. If that context has now disappeared and no longer makes sense, the trade isn't valid and we exit. In terms of the target, again, it's not always predetermined. Obviously, I'd love to say, that the target on a flag is the length of the pole, but again, guys, that's a fallacy. The market doesn't move in that way. The market will move in a manner in which the participants decide to make it move. So it's not based on a pattern. It's based on if I'm expecting momentum and I'm expecting continuation, once I get that break and the market moves nice and aggressive to the upside, the minute I start to see someone else or a seller step into the market and start to sell the market, that's when I get out. So I get out when the market tells me it's now time to get out.
Perfect. I completely agree. I want to thank you for this webinar. I like it a lot, and I would love to have you back at some point in the future.
Thank you very much.
On the screen is all of Brannigan's contact info, so if you have any further questions, please feel free to contact him directly, and he can answer those. All right, everyone says thank you, and there were a lot of comments of people really enjoying the webinar, so.
Brilliant. Thank you very much. And yeah, I mean, obviously, guys, follow me on Twitter. I'll get me on Periscope. We'll have a chat tomorrow. FOMC. Again, I'll give you a little bit of context, a little bit of understanding, help you develop your your approach and your strategy and your understanding to the market. And just if you can become a better trader by listening to one Periscope, heck, take advantage of it, guys.
Sounds good. Talk to you soon.
Brilliant. Thanks, Derek.
You too. Bye.